Hello, friends, and welcome to the Optimized Advisor Podcast, where we focus on optimizing the well-being and best practices of insurance and financial professionals today. On this show, our objective is to help you optimize your life, optimize your profession, and learn from other optimized advisors. I'm your host, Scott Heinela. We hope you enjoy the show. Welcome, Walter Young. Welcome to the Optimized Advisor Podcast. We appreciate you taking the time with us today. Sincerely.
It's my pleasure to be here. Excited to share some ideas with you and your listeners and viewers.
One of the things that, the primary focus of today's discussion, it's going to be on the fifth option. Let's not release, the cat out of the bag yet. But if you can, do a proper introduction of yourself. Tell us a little bit about yourself and what prompted you to the fifth option, and what is the fifth option?
Yeah, that's So we won't let the cat out of the bag, but we'll get into some detail here. So, by background, I have a master's in business administration, MBA, went to MBA school. I worked for Deloitte Consulting for a number of years. So I came from kind of a corporate background, but then I merged into the personal finance with coming into the insurance services for probably the last 15, 20 years. And one of the things that really intrigued me all the time was the reality that everything we learned in corporate finance could be applied to personal finance. And as we talked a little bit about in the book, one of the things I see is that, there's two kinds of finance. There's corporate finance and personal finance. And even though they share the same word finance, they manifest themselves in totally different ways. Where corporate finance is all about cash flow, movement of money, earnings, those kind of things. That's what you see on CNBC. And unfortunately, personal financial planning revolves around balance sheets. How much have I saved, right? When, most of the time when someone sits down with their advisor, first questions they always ask is, how much do you have in your accounts, right? That's a balance sheet question. And the real mystery is, how do I take a balance sheet and turn it into income? And so that was, some of the conversations that I've been having with a number of folks in the industry. And so I decided to write a book called The Fifth Option, which really helps take some of the more modern thinking of how retirement income planning works today and put it into a story form that I hope is accessible for the average person. We know there's a lot of, financial white papers and such, but that's not always easy for the average person to read.
And I could have done a better job clarifying what I meant by not letting the cat out of the bag from the fifth option. I was referring to what you just did and covered, which is the fact that you authored a book called The Fifth Option, and we will work through some of the key points in that book that were very intriguing to me and I think very insightful, leading to the end, which is then letting everybody know the big secret of what the fifth option is. We're not going to tell anybody yet, so please keep that a secret until the end, please. So to set this up properly, let's take a walk down retirement memory lane. And one of the key components that you tee up in the book, I think very, very succinctly, is the three-legged stool, which is your traditional retirement, right?
Yeah, exactly.
Talk a little bit to that.
Yeah, and in fact, if we go back just maybe a little bit before that, we recognize in the 19th century, the 20th century, there was no retirement, right? People just, people worked until they died. The people worked until they literally couldn't work. And it was slowly the evolution of three components that came together that allowed for people to retire. The first was in the late 1800s, American Express came up with the very first private pension. And that pension was there to help attract and retain good talent, no different than it is today. But one of the side benefits was it was an ability to let some of the older workforce go with some dignity. It gave them a sense that they could leave the workforce and make room for some of the younger folks. And then we move to the 30s, we get the Social Security, right? And so Social Security becomes a safety net for people that actually live longer than the average. Remember, Social Security at the time, the average life expectancy was less than what Social Security's age was. And so those two together began to allow for a safety net for people to retire. And then the third part of the stool is the personal savings, right? Back in the old days, people actually used to save money. And so when we think about the strength of that three-legged stool, it was the fact that we had a pension that was guaranteed income for life provided by as a gift for your 30 years of service. We had Social Security that was given to us by the government. And those two together oftentimes could be, 50, 60, 70% of your working income. And then money that you saved up on top of that allowed people to have a very confident way of retiring into those golden years.
And so then we get into the discussion. So fast forwarding, right now it progresses towards longevity and volatility. We now know less and less of people's retirement is tied to anything due to a pension. Those are pretty much all gone to the wayside. So the third leg of that stool, which was the minimal or almost non-existent leg of the stool in yesteryear, is now predominantly, if not all, the bulk of the retirement stool. And so there's where in the book, a lot of this just comes down to, and I don't want to turn the eye to, I mean, so many people, just the layman, a part of our job as an advisor is to be the advocate to customers, but also to help them understand very important and critical components to just overall money management, cash flow management. You teed up in the very beginning. A lot of these principles, there's an overlap between corporate finance and personal finance. Your balance sheet is a very critical component. And so it's our role as the advisor. But a lot of these things as individuals, we just really don't understand the weight of, for example, longevity and volatility. There's an example in the book where it goes through a rate of return of 13.68 as a gross return in terms of my investment assets. And your natural thought process would be, okay, well, as long as I withdraw something less as a withdrawal rate, and the example was 10%, I'm going to have a successful retirement. Well, nothing could be further from the truth, even though you think about, geez, 13.5% is a pretty damn good return, 10% withdrawal rate. Yeah, I could live on that. But I don't want to steal the thunder, but the thoughts from your standpoint, speak a little bit more to that.
Yeah, you bet. So one of the issues of the failing three-legged stool is that is retirement income is all about your savings, what you have to save. And if we think about 30, 40 years ago, interest rates were very high. And so we think about our grandparents, right? They could put money into a bank and they could just live off the interest, right, for a large part. And that's what, you might remember your grandparents going to the bank and checking out their passbooks and collecting their interest. But the problem is, as interest rates have fallen, it has forced people to have to manage withdrawals from their investments. And that allows us to have to deal with volatility now, meaning we know the market isn't a smooth average, right? You're referring to the book where there was a 30-year period of time where the market averaged over 13%. So if I told you for 30 years, Scott, I was going to give you 13% and you thought you could take out 10 and it turns out you were broke, you would come to me and say, what happened? I would tell you, I don't know. The market averaged 13%. I did everything in my job. But the problem is the market is not an average, right? It's made up of many different numbers. Some are positive, some are negative, some are big, and some are small. And it's the
ledger part of the book of the most dangerous belief, right? Is that, are we now getting in this section of the book where it's talking about the most dangerous belief?
Yeah.
Possibly in the yeah, okay, got it.
Correct. And so one of my favorite things to tell people is if I have 2 barrels of water, one barrel has 0 degrees water, one has 200-degree water, and I put a foot in each one, on average, I should be comfortable, but I really have 2 unhappy feet, don't I? Right. So we have to be really careful about what an average means. And so, we use it as some way to project our money into the future. But the reality is when it comes to retirement income, the sequence of return that you get, which you will never know until your last day, is going to determine how well you can take money out. And so a lot of studies have been done around what is the appropriate amount of money you could take out of a volatile asset. And that's, we get into that in the book as well.
So the sequence of returns risk, I mean, what we now know about this, and what's crazy about this to me is like, you take what is a very simple concept, really, and we as an industry have done a really good job of just making it overly complicated. I mean, I've seen so many examples of sequence of returns risk over the years, and some are just so complicated. So that the layman looks at it and it just glazes over. How have you found a way to succinctly and simply illustrate what sequence of returns really is and what the vulnerability is to a given household? Yeah.
So I think a couple of things. Just theoretically, we just let people understand, they get this intuitively, that if the market's down 20 or 30%, or even down 10%, and you take money out on top of that, you've lost twice. And people understand that that's a double loss. What they don't always understand is how hard it is to get the markets to go up enough for you to even get back to where you were the year before, right? That's the part where people don't understand. And so I've heard lots of different terms. Some people call it dollar cost ravaging, one of my favorites, right? So the idea is that, when we're saving money, when the markets are up and down, that's okay because we can pick up shares on the cheap when the market's negative. But when it's time for retirement, it's 180 degrees the difference. That when I'm taking money out, I have to be so careful not to take out money during negative markets, because that is the fastest way to go broke, right? And people, I think, intuitively know it. The way we know that the people intuitively know this is that people die with more money than they need to. It's because they're so worried about how much can they take out of their accounts that they'll end up taking very little. And so what we want to help people understand is that there are other options for retirement rather than just the 4% rule, the safe withdrawal rate strategies that persist today. There are other strategies, other options that are available to them. And so then we also could just do some math and just show some show their finances in different software programs to help them really see the power or the destruction of taking money out during negative years.
It's one of those thoughts where people just naturally think, all I need to do is accumulate enough, quote unquote, enough assets, and this is directly going to correlate to what a successful retirement will look like. Mm-hmm. And that's just not necessarily true. I mean, yes, if I accumulate millions of dollars and I spend extremely frugally, then of course, that would be a successful retirement. But as we know, that's very few people. They work their whole life to accumulate as much as they can while maintaining a healthy and active and what they've believed to be a fruitful lifestyle. And then they would like their retirement, Lord willing, health-wise, right, to be equally sufficient to what they've been accustomed to.
That's exactly right. In fact, there's a study done by Allens that suggested that people are more scared to run out of money than they are to die. Think about that for a second. They're more scared to run out of money than to life. That was not our grandparents' story.
Correct.
They were never going to run out of money. But that is the modern day's economic challenge in retirement, is exactly that dilemma.
So the book then kind of segues into some potential retirement planning strategies. One is the Beat the Bear account. So if you can talk a little bit about that.
Mm-hmm. Yeah. So maybe I'll set it up by saying that when people go to retirement, traditional retirement planning scenarios, they take a look and they project how much money they might have in investments, and then they just deploy the 4% rule, right? And the 4% rule, it simply just says I should be able to take out 4% of my account value, and it should last about 30 years, about 95% probability of success. That was all the work that Bill Bengen did in the 90s, that kind of set that stage for that rule. That is a balance sheet approach. That approach means that I have to save up a lot of money in the balance sheet because the 4% is such a small number that it requires me to save more money than I really need to. And the 4% rule is there to safeguard in case there's negative years early on in my retirement. But what happens if I have great years early on in my retirement? I might have been able to spend much more than 4%, but I'll never know until my last day how that was going to go. And so therefore, we tend to play a lot more defense by using the 4% rule. The idea behind the Beat the Bear is that if I can negate the effect of a negative market, especially early out in retirement, by having a non-correlated asset that I could pull my income from, then I'm not bound to the 4% rule anymore. Mm-hmm. If I know in the first handful of years of retirement that I'm not going to have a negative experience, I don't have to play by the 4% rule. I can now take out closer 6 or 7% with the same risk as the 4% rule. What that does is it unlocks my balance sheet. It gives the ability for my balance sheet to spend better because I'm setting up a cash flow strategy, not just a balance sheet strategy. And so that's why I think that beginning the conversation of understanding some corporate thinking along with personal finance is so powerful, is that I have to understand how is my balance sheet going to spend. Scott, if you have $1 million and I have $1 million and you have a non-correlating asset that supports you during your negative years and you could take out 6%, you could live on 60,000. I have to live on 40,000. It's the same balance sheet.
Mm-hmm.
The question is, how did I create the strategy to access cash flow? What did I do to set that up, hopefully earlier than later in my saving years?
And so some of the solutions that I'm going to say solution sets or products, although I typically dislike to use the term product, but some of the solution sets that we could deploy and not limited to, this isn't exclusive, but some of the options would be something along the lines of a short duration annuity or cash value life insurance. These could be used as your quote unquote beat the bear account.
Correct. Something's
Can you
not
talk a little bit about your preference?
I like the life insurance because of all the other benefits you get with it. So if you think about what comes with life insurance, I get a tax-free buildup inside that. I get long-term care potential. I get liability protections. I can use the money as kind of my working line of credit in and out while I'm during my working years. There's lots and lots of benefits that come with it, as opposed to just the annuity. Now, the annuity is typically for people who are a little bit later in life, who are trying to get
or unhealthy.
Or unhealthy would be a great experience. Yeah. So I prefer the cash value life insurance because all we need to do in the cash value life insurance is just get maybe 3 to 5 years of income in it. And now I have plenty of ability to beat the bear when those negative markets come around. And that will extend my asset base.
And so to summarize a little bit, the thought process for a consumer advisor listening is when the market returns are down, you obviously go to the beat the bear account. That's where you're going to take your withdrawals from. Wait for the market to rebound. So market's positive. Then do we then look at replenishment strategies where we take some of those profits out of traditional equities or at risk assets and we move those back into the beat the bear accounts?
Yeah, I think early on you want to be cognizant about potentially refilling it for the next series of negative years potentially. As we get later in life, I think it just becomes more that's your option, right? Because obviously the death benefit will cover any loan that you might have outstanding. But I think, certainly you like to have that 3 to 5 years of money in that cash value, especially for the first 10 years of retirement.
And of course, all of this, take it with the standpoint of we're not providing any tax advice. Depending on the asset class, whether it be qualified or non-qualified after tax, you get, step up of basis upon death. So there's a whole layer of nuances that need to be worked through to make those pertinent decisions of selling certain investments and repositioning them and so on and so forth. Okay. Any further comments on the beat the bear strategy?
No, I think that's fairly, so the beat the bear strategy, who is it for? It's really for people that are comfortable with markets and are looking to be more efficient with their withdrawal rate.
Got it.
So I still have to have an eye on the market, right? Because most, we'll say, 6-7 years out of every decade, the markets are positive. And so I'll still be looking to the markets. I still have to have a portfolio. I still got to manage that in a proper manner. But I'll have this kind of 2-bucket approach where markets are positive. I can go to my investments. Markets are negative. I can go to my cash value life insurance, and I can manage my retirement that way. And what that does is it unlocks that withdrawal rate again from going 4%, maybe closer to 6 or 7.
Yeah, I mean, there's multiple things that I like about that. Number one, I love the phraseology, beat the bear. That's fun. 2, it just naturally makes logical sense of, look, I want risk. I want diversification. Why? Because I know over time the returns are going to be there. But I do need a stopgap for market downturns, which are completely natural and normal. And so then the idea of introducing cash value life insurance as a solution set for that is also great because it's utilizing cash value life insurance as an asset alternative, not just life insurance, death, pass on assets to beneficiaries. It actually helps to showcase the cash value life insurance with multiple benefits, not just rate of return that's tax efficient, potentially tax free. You've got the LTC benefits. You've got a whole host of potential benefits that the product can provide. So that's great.
Yeah, and one last thing, I think for the big knock it gets is that it doesn't grow as fast as the equity market does. And I think one of the things that we need to be thoughtful about as advisors is if I can use my cash value as part of my bond portfolio, then I'm not sacrificing the equity component that I would have had anyway. And in many regards, it probably is a tremendous diversification to bonds in general, because it has that no loss provision in it. So the ability to just basically say, if I'm at 60-40 portfolio, don't change the 60% of your portfolio, just change some of the elements that's in the bond provision, and you probably will have a very similar, not the same growth trajectory.
I love that. Makes perfect sense to me and to us. I also really like the way that it's positioned, which I think for many consumers, individual clients, it makes a lot of logical sense. All right. Another strategy that you touch on is the bucket strategy. Now, soon, later. Let's talk a little bit about that. Tee that up for us.
Yeah. So this would be kind of the next step of risk. So beat the bears, or someone who is comfortable with the markets, likes the markets. The bucket strategy is more just of a traditional bucket strategy. I like to use 3 buckets. Some people use 5. There's all kinds of numbers of buckets out there. And this is for people who are moving more towards that conservative nature and income. And the idea behind these buckets is the now bucket is for any dollar that I'm going to spend in the first year of retirement, right? So, a lot of people also ask, what if the market, how do I know the market's going to be positive or negative? Well, because we start out with our first year of income ready to go. And so think of that being in the now bucket. That's bank products typically, right? Stuff that's very liquid.
Very liquid. Yeah,
very safe, very liquid, accessible. And then we also want to throw in there any kind of planned expenses for that year. Maybe it's a roof, maybe it's a car, maybe it's a vacation. Whatever we're going to spend that first year, we just want that to be liquid and safe. Then the soon bucket is years 2 through 10. And these really are the workhorse of income for that next 10 years. We know that, that 10-year period right before and right after retirement, called the retirement red zone, is one of the most critical time periods to make sure you avoid any kind of market loss. And so what I typically look at is we put 10 years worth of income between the now and soon bucket. So 9 years goes in that soon bucket. And it's there to draw down that period of time for that next 9 years. Typically, those solution sets are, potentially fixed index annuities. They could be maybe a bond portfolio. So you have 4 ideas that you can do. You could have a spend down approach. You could have a dividend or interest approach. You could buy a fixed index annuity with a lifetime rider, right? You could just turn that into a forever income bucket. So you can have different kinds of strategies within that.
Or maybe a fixed period, certain SPIA, something like that as well. The yields are there.
So what we're really saying is, help me indemnify my income for the next 10 years. And what I tell clients and other advisors is, just give that client the sense of confidence that all the trips and things they want to do with the grandkids will not be taken away because of a market downturn. Mm-hmm. Their income is visible for 10 years, no matter what happens.
Right.
And that gives people a lot of confidence, a lot of excitement, because we know that if, you just ask them, if the market crashes 30% next year, are you going to go on the trip? I don't know. People are going to be nervous to spend that money if they didn't put it in a proper place, right? So the soon bucket gives us that nice vision of 10 years, likely more, because if it's in some sort of an account, it's likely to grow a little bit, right? It's not under your pillow, that dollar. So it's somewhere between probably 10 and 13 years of income. And then the later bucket is where the riskier assets go, right? That's really the growth of the portfolio sits in that later bucket. And it's there for 10 years because we know in 10-year cycles, typically markets are positive. And so we want to give it that time to get through, a downturn at any given time and still have the ability to grow back at that 10-year mark. And it's very simple, right? In very simple terms, as that soon bucket is depleting, we just eventually refill it with the later bucket. And we know that if the market can average, just a modest 7%, then a portfolio should double in 10 years. Right. And so we have the ability to understand that this later bucket will be worth twice as much typically at that period of time. That allows us to fill that soon bucket again. And sometimes we may cheat a little bit. Like if we're in years 5, 6, or 7, and we have a big up year, we might steal a little bit from the later bucket to bring it back into the soon bucket, just to extend the life of that income a little bit more. Because the one rule is we don't want to get to the 10th year to refill that bucket in case that's the negative year, right? So we want to make sure that years 6, 7, 8, 9, 10, that we're harvesting some gains just to kind of keep kicking that income can down the road, so the clients feel like they always have this beautiful vision of 5 to 10 years of income that's ahead of them.
So in the latter phase, let's say the third of that 10-year period, your part of your strategy is, okay, we've got to start to de-risk some of those assets because we want to, again, we've got to keep an eye on market volatility, i.e. sequence of returns risk, and we've got to mitigate that exposure.
That's right.
But that's how we're going to buffer that.
That's right. We've only buffered sequence of returns or sequence risk for 10 years. That's it, right? Or for how many years we put into that soon bucket. So we still have sequence of return risk to deal with. We've just given it a longer break from having to manage it from year to year like the beat the bear approach is. So you're absolutely right. We need to be thinking about if we have an unusual up year, is that a good time just to harvest some of that gains, shove it into the soon bucket and extend that period of time some more?
All right. So as we transition now into what the fifth option could potentially be, I think it's a good point to take a step back and say, okay, let's just kind of look at the lens of retirement planning as a whole. And in the context of what defines when I can potentially retire and the context of retirement planning as a whole, it really boils down to four major points. One is, let's say I'm at a shortfall of retirement. Well, or I'm working towards retirement. I can save more than I'm already saving. That's one option. The other one is I'm 60 years old. I'm saving all I can save, but instead of me retiring at 65 or 66, I'm going to have to work to 60 to 70. Let's just say work longer. The other option is I just need more return. I'm not comfortable with it, but I'm going to make the deliberate decision to put more risk to hopefully generate better returns. And the fourth is probably the worst of the four or the least palatable. And that's, I got to lower my retirement expectations. I've got to start cutting here, reducing expenses, less vacations, less of the things that I really dreamt of doing. And that's just not favorable.
Yeah. And so where I've seen this a lot is when we sit down with people in their maybe 40s and 50s and we talk about what retirement looks like, they all have these wonderful dreams, right? We're going to travel with the kids. We're going to do all the things we want to do. And then when we show the path they're on or tell them more succinctly, for every $40,000 of income you need in retirement, you need $1 million saved. And people just are shocked. That is an astonishing number. Think about that. If for every $40,000 of income using the 4% rule, I need to have $1 million. So if I'm used to living on $150,000 or $200,000 toward the end of my career, I need millions of dollars to be anywhere near that same standard of living. And so we go through the four options like you did. Well, there's four choices we can do. We can save more money, which is not always possible. We could take more risk, but I don't want to take more risk. I could work longer, but maybe you can't. Maybe your job doesn't let you do that, or your body won't let you do that. Or fourth, we can start cutting back on all the things you were hoping to achieve. But luckily for us, perhaps there's a fifth option, right? And the fifth option is understanding how to recreate and combine financial instruments to be able to unlock again that 4% withdrawal rate that is such a low barrier to retirement income. And the fifth option really is the combination of understanding how actuarial science and investments come together to ironically create the same confidence that pensions and Social Security once gave us. And that's the idea behind Pension Max 2.0, is that now we can understand that we can recreate the power of a pension. And even more importantly, we can create it and customize it to what we need, as opposed to just walking away from a company in the old days and just getting kind of whatever they offer. That we can create that safe, predictable, and guaranteed income stream that empowered so many generations to be able to live their retirement dreams the way they wanted to.
And so high level, how does that work? What does that look like? Is it a blend between a couple different strategies and that's sprinkled in with, let's just say, a bucket strategy, and then also deploying some of this Pension Max 2.0? Tell me more about the mechanics of it all.
Yeah, so Pension Max 2.0 is for the conservative investor. These are the people I say, like, when they go on vacation, they don't want to watch CNBC, right? They're done with that. And so this is a way of creating a lifetime of guaranteed income with a twist. So if we go back to maybe, 10, 20 years ago, there was a term called Pension Max, right? You probably heard that, and you probably did some of that, where we would sit down with people that are about to have a pension, and they had to decide, what kind of pension do I take? Do I take out a pension that's just on my life, but if I die, the income stops? Do I take out a pension on our joint lives, but how much does each one get? And all those had different payouts. And so if we think about the 4 options that come with a pension, if we had a crystal ball and we would know what our life expectancy was, we would recognize that 3 out of the 4 options, we should have chose the life only. So for example, if I'm married and I have the pension, if I'm the one that lives the longest, I should have taken the life only.
Right.
If we both die relatively similar, I probably should have taken the life only.
Mm-hmm.
The only one that doesn't work is if my spouse outlives me, right? And so
in significant fashion.
And because of that risk, we always elect the lowest payout that the pension can offer us. And if we think about the delta between the top level and the level that we typically choose, that's a life insurance premium, isn't it?
Mm-hmm.
If I was able to buy a life insurance policy, then I could every single time take the life only option, knowing that if I die soon or ahead of my wife, that all the money comes back to her that she would need to continue her lifestyle. But if we both live a long time, then we know that there's a legacy that's provided to the children where a pension wouldn't give that to us. So we can take dollars on our balance sheet and we can purchase certain kinds of annuities, whether it's a single premium immediate annuity or maybe a fixed index annuity that has a lifetime rider. We can be very brave about the fact that we could take a life only option and know that my family will be completely reimbursed with whatever dollar I put into that insurance company, or my kids are going to get it. Someone's getting all the money back. And I think that's a very elegant way of handling the retirement income. Probably the most important thing about this, Scott, is that you can get SPIAs in the 7 and 8% rates. So what does that mean? It means I can actually have twice the income that the 4% rule would provide and still be able to provide a little
market risk and fully guaranteed.
Fully guaranteed. And I know that my legacy will be intact because when I pass away, all the money I gave to that insurance company is coming back. Whereas the 4% rule, the legacy is unknown, right? If I have good markets at the beginning, it could be a lot. If I have bad markets, it could be very little.
The other thing that you could do with that is do some, and I would suggest this is some of the dialogue and really work that needs to be done between client and advisor, but it's pretty easy to do the math and work backwards to say, okay, the amount of life insurance that you would need, you Mr. or you Mrs., depending on who were to pass away first, to replenish the balance sheet to provide adequate income would be X. But what I could do is say, okay, instead of me doing that assessment and calculation the first day of retirement, assuming you passed away, like worst case scenario, first day. No. Let's do some conversation and some analysis to say, well, what if you passed away 15 years, or what if you passed away at your earliest life expectancy, maybe minus 3 or 4 or 5 years? How much insurance would you need? Well, it's obviously something less than the amount of insurance that I would need on day one of retirement.
Correct.
So, and in fact, that's part of that journey, I would imagine.
Yeah. And so, Scott, here's a really critical piece to this. And this is something that clients do struggle a little bit because they're not used to thinking this way, which is think about how many dollars are required to fund your retirement income using the 4% rule. So let's just use a very simple example. Let's say I want $40,000 of income and I have $1 million in the bank. Well, 100% of those dollars are dedicated to creating that $40,000. There's no room for an emergency. There's no room for charity. There's no room for giving gifts to my kids. They are all completely reserved to create that income stream. So while people say, yes, it's liquid, it's not really available to us, is it? It's not accessible, right? Now, listen,
when you take a withdrawal,
that income goes down, right? So it's so it's trapped. But on the other side, let's say I bought a SPIA and the SPIA is paying 8%. I would only need to put $500,000 into it to create the same income. Mm-hmm. And now people would say, but I just lost $500,000. I don't have that liquidity anymore. But who has more liquidity? The person that has $1 million where all the dollars are required to generate the income, or someone who has $500,000 where there's no requirement to generate income? Think about that for a second. Right.
Yep.
Now I can give money to my grandkids. I can give money to charity, or I can choose to spend it on me and have more lifestyle. but I freed up dollars that are no longer required for generation of income, right?
That's my basic living expenses, which is the quote unquote the paycheck for life.
Exactly. Yeah. So one other thing I think would be fun to bring up is I use 4 questions that I think people might be interested in using, which is when we think about something, we're meeting someone for the first time, I always ask these 4 questions, which is yes or no, you would like to generate your retirement income using the fewest dollars possible. Yes or no, you would like your retirement income to have the least amount of risk associated with it as possible. Yes or no, you would like your retirement income to be as predictable as possible. Yes or no, you would like to, if possible, to leave a legacy if possible. Mm-hmm. And everyone answers yes. But if they don't have actuarial science on their side, they cannot answer yes. The answer is no to every single one of those questions. A 4% rule does not offer an efficient way of generating income. It does not offer a predictable income, and it does not offer necessarily a safe way of getting to your income. And the legacy is completely unknown. So a market-only approach does not answer those questions to the affirmative, which is why I call a balance sheet approach that we talk about. That's why I call it BS, because it doesn't generate the answer for those 4 questions that are so important, right? I can recraft with the same asset base a superior income stream for you at retirement so that you are using fewer dollars, taking less risk, having more predictability, and by definition, probably legacy. That's the power behind the 5th option.
That's great stuff. Beautiful. Very, very good. How do people, obviously they could Google search you, but if they wanted to connect with you directly, or where are you out there in the world?
Yeah, my website is thefifthoption.com. You can find the book, The 5th Option, on Amazon. And so, I'm always welcome to consult with folks, talk to people. I do a lot of speaking around this, around the country about just, the 5th option and retirement income planning in general, right? And the very notion that you really all should be thinking of your household like a business, which is cash flow centric first. Create the cash flow strategies.
It's a good book. I mean, it's a very easy read. It's very, I would say, consumer palatable, right?
That was the point.
Wonderful. Well put together. It's conversational in how the text is delivered and the verbiage in the book, but it's got all of the high level points that we covered in today and additional that we didn't. So for those of you who are interested, please reach out, get your book. Thank you very much for the time, Walter. It was much appreciated.
It was my pleasure. Wonderful to be with you.
Till next time. Cheers.
Thank you for tuning in to today's episode. Please subscribe, like, share, leave a comment or review. Be sure to check us out on social media at Optimized Advisor Podcast. Till next time.